Welcome back to the Wealth Care Podcast. I'm Brianna and this is Glenn Evans, and together we make up the Evans Family Wealth team here in Ottawa, Ontario. Today we're diving into part 3 of our ebook series. This is a series where we are going into some of the free ebooks that we have available on our website. The first one we covered off was the Retirement Red Zone.
Yep.
And that one was all about how there's 5 years before and after retirement where mistakes are really critical.
You don't want to screw up.
You don't want to screw up. So that was what our first episode was about. The second one was all about something that we call the 5% solution. And this was about incorporating potentially a 5% allocation to Bitcoin instead of just having a traditional 60-40 approach.
Remarkable the difference that just that 5%
Absolutely
brings to portfolios.
Absolutely. We noticed that this would help increase the portfolio's return while decreasing some of the volatility, which is what we were not expecting to see, but thrilled to see. And in today's episode, we're diving into something a little bit different. We're going to actually zoom out a bit, and instead of just focusing in on a portfolio, we're going to be looking at some of the mega trends that we're seeing in the global economy.
Yeah.
So this one is all about the blue chips of tomorrow today. So why don't we start by just covering off, most of our listeners here are Canadian, and that tends to mean that they are invested in Canadian companies.
That's right.
So why don't we cover off, just as an intro, some of the basics about blue chips in Canada?
Well, I mean, almost all of our clients, that's really their most comfortable place are the Canadian blue chips. And when we say Canadian blue chips, we're really talking about a pretty short list of securities, because the truth is in Canada, there just aren't that many blue chip companies. About 36% of the Canadian index, the Canadian stock market, is made up of the financial sector. And the vast majority of that is made up of the big 6 banks.
Right.
And by contrast, energy in Canada is around the 15% kind of mark, 17%. And technology as a major sector is only about 10%.
That's right.
And so in Canada, when we talk about blue chips, just by percentage weights, that almost certainly means that you're going to be in the oligopoly type banks. You're probably going to be in some of the rails. You might be in some of the grocers, but you're really likely not to be in technology. You might have some energy, but you're really going to be, it's kind of shorthand for the banking sector, a couple of insurance companies, and maybe the rails.
That's right. Yeah. We've seen that in Canada, there tends to be quite an overexposure to the financials, the utilities, and an underexposure to technology. Yeah. And what we've noticed there is that it's created a bit of a blind spot for Canadians in their portfolio. If you had just been invested in the TSX 60, you would have missed out on a pretty big chunk of the tech revolution, right?
Yeah, I mean, just mathematically, it's impossible for the Toronto stock market with just a 10% allocation in technology, which, you know, for whatever your preference is, it has been the fastest growing sector for the last 35 years or so. High volatility, but that's where all of the earnings growth has been. And in America, that sector, if you include Tesla, is approaching 40% of the stock market, whereas it's maybe 10% in Canada. And that's assuming we don't lose Shopify to the US at some point in the future. So the dilemma for Canadians is that if you're trying to benchmark yourself against the US stock market, as a for instance, and you only have exposure to a quarter of the exposure to technology as the US index has, then just mathematically you are not going to perform as well.
That's right.
And so that becomes a blind spot for Canadians because, you know, we think that we're kind of closet benchmarking against the index itself, but we're not really realizing that the index in Canada is really a huge bet on Canadian financials and an implicit short or underweight in Canadian or in technology stocks in general. Does that make sense?
It does. It does. This is something that we, in the industry, the term is home bias. And in Canada, we really do have a home bias to buying Canadian companies. And by default of the index, that tends to be not buying a whole lot of technology.
Yeah, just by a process of elimination.
That's right. It's one of these behavioral biases that in finance we talk about a lot because it's a big risk to investors when they are just invested in their domestic country.
That's right.
So that's something that we'll dive into a little bit later in this episode, is the benefit of diversifying globally to help increase our exposure to some of these sectors that in Canada we just don't quite have access to in the same way.
That's right. And I should just kind of make the point that this isn't to discount the investment case for owning Canadian financials. It's just a question of extremes.
Exactly.
Right?
Yeah, how do you weight them? That's really what this comes down to. So it's important here that we note that blue chips used to mean resilient, and we kind of had the blue chips in this quote unquote safe bucket,
Yep.
right? They feel like safe investments. But what's important to note is that blue chips of tomorrow might actually be companies that are just relevant.
Yeah. Yeah. There's this great statistic we share in the ebook that of the Dow companies, only one was actually in existence in 1925, just GE. It's the only of the Dow companies that even exists anymore. And so the very notion that there is a subset of companies that are blue chip, that are kind of a one investment decision trade where you just buy them and hold them forever. The reality is that just hasn't been the reality of investing in North America for the last 100 years. What we consider today as blue chips might not have been considered blue chips 25 years ago.
Yeah.
They might not even have existed 25 years ago. And certainly there is a season to all of these types of companies. And part of our investment case and our investment beliefs is that we may be seeing kind of the peak in Canadian financial companies.
Yep.
And that just the fact that the rate of growth of the technology sector is so much greater than the rate of growth in financials that we think that the financials will probably play second fiddle.
Right.
If you would, to the technology stocks in the future.
Yeah. So we've talked a bit about the blue chips of today, I guess, or maybe even the past.
Mm-hmm.
But what is it that we're looking for when we think of modern blue chips and blue chips that might make up tomorrow?
Well, I mean, really what we're looking for is companies that are emerging as having a dominant position in a growing industry.
Right.
Right. So it's kind of that compounding of dominance, both in earnings growth and in valuation, but also you want to be a growing business in a growing sector.
Yeah.
Right. I would just, again, I come back to the Canadian financials just because it's so current with Canadian investors. With them already occupying 36, 37% of the Canadian stock market, you really have to ask yourself, are they going to go to 70% of the Canadian stock market? What's the greater likelihood that technology goes from 10% to 20%, or that financials go from 37 to 70%? I mean, to me, it's just a bet that tomorrow's growth leaders are going to be the companies which have grown at the fastest rate of compounding. And those companies today are technology names.
That's right. We've all heard about the term the Industrial Revolution. That's a term that's common to Canadians and to, I guess, a lot of people around the world. We've all heard that term. And one that we're starting to hear a little bit more nowadays is the AI revolution.
Yeah, we're hearing it a lot.
Yeah. So tell me a bit about it.
Well, the AI revolution is thought to be a trend which will make the Industrial Revolution look like small beer. Mm-hmm. This is the application of artificial intelligence to effectively every industry. So a good way to think about it is that it's like adding electricity to the original technology, industrial revolutionary.
I like
names,
it.
Right? So it's like every sector is going to be electrified, if you would, by artificial intelligence. And what that means is that they're going to be more efficient, they're going to be more productive, they're going to be able to grow at a faster rate is the expectation. And so we expect that those companies which are leaders today in this field will grow at even higher rates.
Yeah.
Right? And so we think that the AI revolution is going to make the Industrial Revolution look like a footnote.
Yeah. And if I'm hearing you right there, it sounds like if AI is expected to transform across industries, sectors, and companies, and even jobs as a whole, this is not just about technology.
No, technology is just kind of the grease that is going to make all of these companies run at a faster rate.
Right. Right. AI can impact things like healthcare. It's going to change the way financials work. This is going to impact those sectors as a whole, not just the technology one.
Yeah, there's no sector that isn't going to be radically impacted by this. Even the materials-based companies, drug discovery, finance, technology itself. You just go down the list and the applications are basically endless. And it should, if we're right,
yeah.
if and this isn't just our thinking, clearly, this is what we're reading. If the futurists are right about this, what we're going to see is an acceleration of development. So, just here's a great illustration. Imagine that there are in the world today, I don't know, 1 million PhDs.
Right.
Right. So these are the scientists at the very top of their game, the smartest of the smart, the very best. Well, we are rapidly approaching a point where we might have 1 million. Right?
Yeah.
I mean, we basically will have limitless, well, limited only by power, limitless intelligence to be able to apply to persistent and thorny problems.
Mm-hmm.
And so even if they're not necessarily as smart as the next PhD or as the best PhD, just the order of magnitude increase in research that can be done,
yes,
that alone should develop value, should accrue value to shareholders.
Exactly. You mentioned there that power is going to be a limiting factor in AI. And what we've noticed is that there is now becoming a partnership between energy and technology. Tell me a bit about it.
Yeah. So this is the interesting thing. Electricity production in America has basically been flat for years and years.
Yep.
Right? There just hasn't been a lot of need for new electricity production. And that's mostly been because America has been seeing its manufacturing base go overshore, go
right.
overseas. And so that demand has faded and been replaced by consumer demand. And so people have been quite happy. And, we haven't seen a new nuclear power station built in forever.
Yeah.
And so there really hasn't been much of an incentive for America and by inference Canada to invest a great deal of money in new electricity generation. What's so amazing is that the amount of power demanded by these new data centers,
yeah.
And just to give you a sense of this, Meta has just announced plans for a new data center. And the data center is expected to be about the size of Manhattan.
Wild.
It's unbelievable. It is so large and they are in such a hurry to build it that they're actually deploying a type of structure, which is, you can think of it as a tent. This is some kind of crazy industrial tent that's supposed to be hurricane proof, because not only are they building a data center the size of Manhattan, but they're trying to have it done like yesterday. And so the great empowering factor here is that rather than government or power utilities being the ones who have to bring forward the venture capital to actually build these data centers and that require this power, but the primes themselves are actually building the power. So we're seeing marriages between Microsoft and Constellation Energy, and we're seeing these different arrangements where these companies are actually taking on as part of their capex the building of energy in order to be able to power these. And so there is great concern that the rate limiting element to the eventual adoption and growth of AI may actually be energy shortage, electricity shortage. And, there's certainly going to be a lot of developments in that field. But right now we're in a situation where the US particularly has basically taken the gloves off. The Trump administration has put forward executive orders and new plans to fast track the development of electricity, in the hopes of avoiding exactly this thing of losing the AI race
right
to China, because China certainly is outperforming the US in terms of its energy, its electricity growth. So that becomes a real niche for Canada to
Yeah.
exploit as well, because we could, in the same way that we provide heavy crude to America, we could also be exporting more electricity, and certainly there is a business case for us to build more energy
For sure.
capacity to be able to export.
There's a real advantage and opportunity there for Canadians, and I think it's important to dive into that a little bit more. So, part of this is about um, data centers need to be built near high energy sources,
Mhm.
right? So, Canada has tons of that available. I
Right.
mean, we've got opportunities in Quebec, we've got places in BC, there's all kinds of energy available coming out of Alberta as
Mhm.
well. We have a vast natural resource capacity that we can tap into in Canada that we haven't necessarily been doing enough of when it comes to the AI revolution.
Well, I think that's entirely true, and I think actually that Mark Carney, Prime Minister Carney, would agree with that. His plans for Project Borealis, which we've written about, are certainly the beginning of a footprint, a beginning of a design for how Canada could actually play a more dominant part in the build out of AI. But you make the point that we shouldn't just gloss over. We have the capacity in particularly in the Montney formation in BC to actually have behind the grid power generation.
Yeah.
So we've got the natural gas. What's lacking is the energy infrastructure to kind of send that electricity through the grid to Calgary or wherever else they might
Yeah.
make these. And so there have actually been proposals of, well, look, why don't we just have gas-fired cogeneration right at site and situate these data centers closer to the energy source rather than bringing the power to them. And
Yeah.
that's a reflection of how much demand is there, that we're looking at all of these different opportunities to power these data centers. In the first quarter of 2025, data center construction was 1% of GDP all by itself.
Crazy.
It's a staggering sum, and Canada could participate more.
Yeah.
Frankly, it's to our discredit that we're not looking kind of further forward and recognizing that, look, we're a leader in hydro, we're a leader in nuclear, we're a leader in gas. Why aren't we doing more of this and sticking our foot into this industry and really securing our future in terms of compute and data center and AI in general?
So, our listeners, you probably are having your ears perk up a little bit here because what I'm hearing is that this is more than just Microsoft, Meta,
Yeah.
Apple, Amazon. There's actually a lot more opportunity here. I mean, we're talking about companies that are energy generating companies that might be huge opportunities both in Canada and elsewhere. We're talking about the technology companies that are actually running these data centers. There's a whole lot of infrastructure behind the scenes that is part of this. It's so much more than just technology.
That's right. I mean, you can, as a former architect, I kind of salivate at the opportunities in the construction industry as well for these. If Meta is building a data center the size of Manhattan, you can be sure that so is Google, so is Microsoft, so are everybody else. And we are seeing tremendous amounts of capital flow into this space. And what's really significant here is that this isn't, unlike some, people are worried about, well, is this a bubble
Yeah.
or not? We may as well just kind of pop that concern right now, just by saying that this is free cash flow from the earnings of these incredibly profitable technology companies
Right.
that is being used. It's not venture capital. They're not raising debt. This isn't like the 1990s and early 2000s where this was IPOs and bringing in mom and pop into businesses that didn't have a business plan. These are the excess earnings of these corporations, which they are plowing back in to compound and reinvest their profits, and building this out in an entirely new kind of well, as you said, the AI revolution that will power. It's kind of this virtual feedback loop, right? Where they're building the tools that are going to then help build the tools to build more tools, right?
Yeah.
And it all requires the power at the get-go. And that's an area, that's a part of this where Canada could take a much more dominant role. But we have to be honest, so far our approach to that has been tentative at best.
Yeah. What's cool about this is some of these companies that we're talking about, we're not actually talking about finding startups or diamonds in the rough. These are companies that are proven, that have a good track record, that have so much free cash flow that they are able to be reinvesting it.
Gosh, that sounds like a blue chip.
Yeah, exactly.
It sounds like a blue chip of tomorrow. And I think this is the entire thesis of the ebook and why we're so excited about it is that, we're not taking bets on flyers. We're not taking bets on unproven technology or small cap companies. These are dominant companies who have a 25-year or longer life in many instances, who aren't taking huge levered long bets in debt.
Right.
They are reinvesting their own profits. Now, that's not to say that there aren't risks. There are plenty. But the point is that this is not a repeat of 2000. This is not, pre-revenue companies. These are companies that are just reinvesting their profits in a way that we believe is going to ensure substantially greater profits down the road.
Right.
Right?
Yeah. So we've heard about this AI revolution, and we know that this is something we're hearing a lot more about these days. Have we missed our chance? How early are we in this?
Well, we certainly haven't missed our chance if we're right in the in trying to grok the extent of this opportunity. We believe it's the biggest investment opportunity of our lifetime.
Yeah, absolutely.
Right? I mean, we think that mobile is nothing in comparison to this. The internet, the internet was a big thing, and many Canadian investors missed the internet out of a fear, and certainly there were some concerns with that. But if we're right about a couple of things, there's just a couple of kind of qualifying statements that we have to make about this that we allude to in the ebook, and the first is this: that all of these expectations for future gains assume that the rate of growth of intelligence in these large language models and in these artificial intelligence models in general, that they continue to climb.
Yeah.
Right. And so we certainly have not seen any reason to think that that's not going to be the case. Naysayers abound. And so that is a risk that we continue to monitor. In fact, I get an update monthly from ChatGPT.
Yeah.
One of their tasks is they have to kind of give me a report on what the status of the build out of this. And we use a kind of a comparison there to the situational awareness paper, which kind of did a roadmap for how we might get to artificial superintelligence. And we still think we're on that path. It's going to be very interesting to see in the next few months. We will get a new model from Grok. We'll get Grok 5, and that's Elon Musk's XAI initiative. And what's significant there is that he is training Grok 5 on the largest cluster of compute ever assembled on Earth.
Right.
Right. And so we're going to know in the next couple of months if Grok 5 comes out and it is a step change increase in utility and in intelligence, that's going to tell us that the scaling laws continue to work. And by scaling laws, we just mean that what we've seen so far, which is that if you double the amount of compute in the training and inference side of model development, you more than double the kind of the accuracy and the intelligence on the flip side of that. Right. As long as that scaling law persists, then it's pretty much just a mathematical certainty that these models will continue to ramp higher. Everybody expects that there will be a decay at some point, and we expect that algorithmic improvements and other things will offset that. But that's the key bet, that the trend that we've seen that continues to accelerate, it's basically a vertical chart.
Yeah.
When you look at it. It's a crazy chart. And if that persists, then I don't think anything stops this train. If that doesn't persist, then the eventual timeline for achieving artificial general intelligence and artificial superintelligence will be extended, but it won't be terminated. It will require more work in order to get there. So long as that is the case, we think that we are in the very early stages of this.
Yeah.
Doesn't mean we won't have large swings, but we think that this is an investment theme for the next 10, 15, 20 years.
Absolutely. And something that is really important to us here at Evans Family Wealth is positioning our clients to be ahead of this curve.
Right.
It doesn't mean that every client will hold the exact same percentages or percent allocations to each of these sectors.
That's
It doesn't mean that they'll all have the exact same exposure. But we feel that it's very important that clients are hearing from their advisor about these opportunities that are out there in the investment world, and that they're positioned accordingly, that they are at least aware and able to make a decision of, I want in, or I'm comfortable staying out for now. So what are some of the ways that we actually help position their portfolios this way?
Well, I mean, it all starts with a conversation. It all starts with trying to help them understand the size of the opportunity, because this gets scary for clients.
It does.
There's something about technology in general. Maybe it's, we watch too many Terminator movies or something. I don't know, but there is an anxiety that we encounter, and the same is true when we talk about cryptocurrencies as well.
Yeah.
Right? There is a
change is difficult.
Change is difficult, and so we like to kind of position this in a way that zero is a reasonable investment if that's what your comfort level is. There's no right or wrong in this. But what we would push back a little bit on clients, especially our younger clients,
exactly,
is that if you're 80 years old, well, if you miss this trend, it's probably not going to make that huge a difference in your lifespan. But if you are 38 or 45 years old, or even 50 years old, and you miss the greatest investment opportunity of your lifetime, we would encourage you not to, right? We would encourage you to even if it's just starting with a small position, and we then kind of compound that position as we get more confidence. But we think this is as a financial advisor, as a fiduciary, we think that one of the ways that we can bring real value and kind of generational wealth building is not by being early, but by being on board.
Yes.
Right? And I think that in this business, the sad reality, kind of the unfortunate reality is it's more acceptable to fail in a conventional way than to succeed in a non-conventional way.
Yeah.
Right? So what that means is that investment advisors can sound pretty smart by kind of throwing shade at the new thing.
Yep.
And kind of hiding behind the conservatism of, what's always worked is this.
Yeah.
And we just think that look, there's a place for that. But we don't think we'd be doing our job for clients, especially our younger clients, if we didn't dig deep into this and really come to a decision about, we actually think you need to know that this isn't a fly-by-night kind of operation.
Right.
This isn't a short-term trend. This isn't meme investing. This is the dominant trend that we're going to be talking about for the next 25 years. And we think actually that the rate of advance is going to continue to be exponential, which means that if you're kind of amazed by what AI can do today, just wait, because it's going to be that much more incredible in 2, 3, and 5 years from now.
Yeah. It's not just about chasing the hype. That's not what we're doing, right? We are taking a whole lot of time to analyze these opportunities, to use our own systems to help actually grind some of these numbers in the background and see what options are out there. We use strategies like global diversification to just have access to more beyond just Canada.
Right.
We still have Canadian allocation, absolutely, but we don't have it all in Canada. And
we should say, we should probably just kind of pat ourselves a little bit on the back by saying that we actually use these tools.
We do.
And in our advisor managed models, we've been using artificial intelligence and machine learning for the better part of a decade. We continue to use it more and more, and we're finding more and more tools and more ways that we can use agents and AI in general to help us with our research and to make us more effective.
That's right.
And being able to cover this at a deeper level than what I could do or what you could do individually. I mean, the great thing for us is that I mentioned the million PhDs, and now you have basically unlimited PhDs. Well, it's kind of similar here, right? I've got one CFA, but I can spool up a whole lot of CFAs, a whole lot of analysts agentically, and we can leverage the benefit of their research in our models.
That's right.
And we personally, I mean, this is, I'm working every weekend, it seems, on this kind of work because it's so exciting, because I'm going to be able to do things that I would not have been able to do even 3 years ago. I can do it now. And when I kind of envision what I'm hope to be able to do if these trends persist, I mean, we will really be able to offer a level of due diligence and research that would be competitive with our much larger peers.
Oh, for sure.
Right?
Absolutely. And I think another important thing to address here is, if you read a lot about the AI revolution and you are big into these technology companies, it might be tempting to just throw all of your money into that. And that's something that we are very cautious of here.
Yeah.
And we really do feel strongly that part of the benefit of working with an advisor is having someone to be able to help manage some of the risk, rebalance in the good and bad times, and help keep you on track with the long-term goal, right? Your long-term goal doesn't have to be 50% returns every year. That's not what it needs to be. It'd be great if it could be, but if that's going to mean that you have massive swings in and around your red zone,
drawdowns,
that's going to be a problem. So it's important that we kind of highlight the fact that, yes, some people like to manage their investments on their own, and we understand that. It's fun to get to trade around your own accounts. But there really is a benefit to having somebody to bounce these ideas off of, to manage some of the risk, to help you develop what your exposure should be. Because for everybody and their own risk tolerance, their own circumstances and objectives, that's going to look really different. And if you don't have someone overseeing it, you run the risk of getting in too early or too late, or not knowing how to manage when the crap hits the fan.
Yeah. Well, you make a great point, and I can vouch for this, having done the kind of back testing of different models to confirm this. But I mean, we've looked at well, what would happen if we just held a basket of these kind of AI stocks and these tech stocks? Well, yeah, you get good long-term returns, but you get lit up. In 2022, you're down 60%, right? I mean, these are not survivable losses for most Canadian investors. And that's why, one of the things that excited us the most in writing this ebook is, we talked about how we're kind of the chocolate and peanut butter.
Yeah.
Of this is we've got the tech stocks in one hand, but we've also got the energy stocks and the infrastructure stocks that are kind of the lower beta, lower volatility we'll call them the peanut butter, and the chocolate is the is the tech stocks. And here's the great news: is that not only do we bring down the overall volatility of these portfolios in our back test by including these infrastructure and energy names, but we actually increase the terminal returns because we don't get lit up with a 65% drawdown like we would if we were just, YOLOing into a handful of tech stocks. And so I think that there are two kind of extremes, I guess, that we're cautioning about here. The first is what I would consider the kind of home bias concern that we outlined at the front, that Canadians are kind of, classical Canadian investors, no disrespect, are kind of hear no evil, see no evil, speak no evil, and be in banks, right? And we think that avoiding the kind of the uncomfortable conversations about AI, we think that's a huge mistake. And so that's our first concern is, you can't win if you don't play with respect to having an allocation in the fastest growing sector of the last 35 years, and probably increasingly. So that's, risk number one is you don't have any exposure to this. Risk number two is you have only exposure to this, right? And so certainly as fiduciaries, our responsibility is to try to find that right balance.
That's right.
It's different for every client, right? This is the great part about working with individual clients, is that we find the right approach for each of them. That's part of our job. But we would caution against either of those two extremes. It's really the sweet spot here for us is getting that balance right between the different sectors.
That's right. So really what this episode and this ebook are all about is the fact that the economy is rapidly changing. Mm-hmm. There are some major trends that are up and coming that we're noticing, and Canadian portfolios should be adjusting accordingly.
That's right.
And at the very least, you should know what options are out there, what opportunities are on the horizon, and be able to make a decision of, yes, I want in, or I'm okay to wait for now.
Yeah, and just to put an exclamation point on that, what Canadian investors have to realize is that there are really not Canadian investments to get this exposure. That's the tricky part, right? Mm-hmm. It comes back to the only 10% exposure in Canadian tech in the Canadian stock market. We don't have a Canadian version of Microsoft to buy.
Right.
Right. So it does mean that we have to be proactive in how we actually go about this. And home country bias is the problem that we have to cure there.
Yeah. So that wraps our episode on Bluechips of Tomorrow today. I hope that you found it interesting. I hope that you have learned something from it. And if you want to know a little bit more, head over to our website at evansfamilywealth.com. You'll see a tab along the main menu there for our free ebooks, and you can download this one and all of our others there. It's free to download. You can have it sent right to your email. And we would just encourage you that if this is a topic of interest, you will find a lot more valuable information in those ebooks. Similarly, if this is something you're not hearing about from your own advisor, if it's something that you have more questions about, you need a second opinion or another set of eyes on your statements to see, you know, how does my portfolio stack up relative to this new opportunity? We are here. We're accepting new clients. We're happy to help. You can send us
what we do.
It's what we do, yeah. There's a Contact Us tab on our website. You can click that or just send us an email or give us a call. We would be more than happy to set up a free consult, no obligation, but we could just take a look over things and give you a second opinion on what your situation looks like and how this might work well in your own portfolio.
We don't want anyone to miss this.
Exactly.
Right?
Exactly. It's too big of an opportunity to miss. And lastly, this was our third of 4 parts in our ebook series. Our next episode that will be dropping next month is actually a little closer to home. It's something a little bit different. This one is all about love, money, and the financial conversations that might be able to lead to a stronger relationship. So if that's of interest to you, tune in next month. We hope you've enjoyed this episode and that it was useful to you. Have a great week, everybody. Bye-bye.